Hello and welcome to the special segment called as MC Pro Select Stock of the Day. I'm your host Nikki Mirchandani, and in this segment, we bring to you fundamentally strong investment stock ideas. Well, today's stock of the day is Craftsman Automation. Let's get to know more about the company and also the triggers that are working in the favor of the company. But first, let's set the background. As a prominent auto component manufacturer in India, the company's primary focus lies within the commercial vehicle segment, serving as an excellent proxy for the CV upcycle in India. The company supplies to major automakers such as Ashok Leyland, Tata Motors, Eicher, amongst others, solidifying its position as a key player within the industry. Let's talk about the performance for the quarter gone by. Well, a significant 53% year-on-year jump was witnessed in revenue, which was primarily driven by a surge in content per vehicle. This revenue boost was further amplified by the acquisition of DR Axion, that is DRA India. However, despite the revenue surge, the EBITDA margin of the company witnessed a correction of nearly 190 basis points, chiefly attributed to an increase in other expenses. In contrast, the aluminium product segment experienced solid growth of around 20% year on year, with the segment margin expanding by as much as 750 basis points due to the operational leverage. Talk about the segment-wise performance, let's address an aluminium product segment first. The aluminium die casting business is experiencing notable growth, with orders received over the past 2 years now starting to materialize into the financials of the company. The shift towards advanced emission norms is poised to increase the usage of aluminium per vehicle, while the increasing adoption of around electric vehicles (EV) is also expected to drive up the consumption of aluminium across the automotive industry. Now, also let's talk about the acquisition of DR Axion, that is DRA, a manufacturer specializing in the low pressure die casting of aluminium cylinder, which heads for passenger vehicles. This acquisition is seen as a strategic move by the company as it marks towards the diversification. Securing an order from Hyundai for its forthcoming Telugu plant, DRA anticipates this new contract to notably boost revenue growth, contributing to an estimated additional 5 to 10% of their overall revenue. In terms of the other segment that they have, that is powertrain business, is only expected to perform in the second half of this financial year. Demand within the commercial vehicle, that is CV, and construction equipment, that is CE, segment stayed subdued, largely due to strong base set in the previous year. Despite this, the management holds an optimistic outlook for the segment, foreseeing a potential uptick in demand for both CV and CE segments in the later half of this financial year. Let's talk about the industrial and engineering segment too. Now, revenue from this segment has shown a notable uptick, recording an impressive around 18% quarter-on-quarter growth in the quarter gone by. This surge in revenue is also led by a significant 370 basis point expansion in EBIT margin during the same period. Looking ahead, the management now anticipates a sustained recovery in the upcoming quarters, driven by positive sentiment in the FMCG, automotive, and pharmaceutical sector put together. Talk about the valuation. The stock is currently trading at an 1 year forward multiple of around 22.4 times. The valuation seems to be reasonable given the growth potential. Well, risk, a couple of them. Let's address the first one, which is any weakness in demand could impact revenue growth, and rise in raw material prices could significantly impact the financial performance of the company. With this, it's a wrap. Thank you so much for tuning in.